Good morning, everyone, and a warm welcome to this LSEG Academy session, where we will be looking at UK fund market for Q3. I'm joined by my colleague. My name is Claire Owens, Customer Success Manager based in London, and I'm joined by my colleague Dewi John, who is Head of Research for Europe for LIPA, who will be taking us through the presentation today. Just a little bit of housekeeping, as we do have a few people on the call today. If you could keep yourselves on mute for the duration of the presentation, we will pause and have some space for questions, and there'll also be some time at the end for a Q&A. If any thoughts or any questions pop into your head during the presentation, feel free to utilize the chat function on WebEx. I'll be monitoring that throughout the session. I can ask any questions on your behalf, or as I said, there'll be space at the end to do so. The slides will also be circulated after the presentation, and we're recording the session today. So without further ado, Dewi, I'll hand across to you.
Thank you very much. Good morning, everyone. As ever, the presentation breaks down into three sections. Macro overview, UK fund market in broad terms, and a look at the sustainable fund markets. Again, as Claire said, if you've got any questions, ping them in the chat or ask them after if you want them addressed within the presentation itself. Just stick them up as soon as they occur to you, and I'll try and deal with them then. Right, off we go. I can get this thing to work. Disclaimer, the important bit. And summary of what I think is the most significant thing at the moment anyway, which is negative flows for equities. A bit different in Europe, but UK is rather pessimistic at the moment. Macro view to start with. Declining risk signals, broadly speaking. Still divergence of base rates between the US and UK on the one hand and the rest of the developed world on the other, despite obviously lowering pressures in both the UK and particularly in the US, not least because of political pressure, steepening yield curves, and the last bullet point we'll look at as well further towards the end. Right. So when I'd introduced this slide a few quarters ago, or actually 2 quarters ago, we were right on the April spike there. Obviously, with the introduction of tariffs, markets threw a bit of a fit. Since then, as the cliche goes, they have taken these events in their stride, climbing the wall of the worry, choose your cliche as you will. But equity volatility as measured by the VIX has declined. Whoops, and I'm going the wrong way. There we go, next one. Looking at measure of risk or attitude to risk within fixed income markets, European high yield spreads, 10 years, again, you can see the same thing is evident here. We've got a huge spike, as you'd expect with COVID. Risk ramped up again, or perception of risk ramped up again around the inflationary spike, and has declined more or less ever since. And we are still in that down leg. As I said before, you can see still that there's a bifurcation, if you like, between European central banks on the one hand and UK and US on the other, and of course Japan right down on the bottom there. And UK yields, of course, anybody who picks up a British paper, you can't escape this. You can see it becoming, for the government at least, in terms of borrowing costs, worryingly high. They've tended to, of late, march in lockstep with the US. They're still heading high. The US has come down a little. But as you can see, the idea that this is a specifically UK thing Look at France, look at Germany. The trend is upwards, even if it's below that which the UK is experiencing. So whereas the UK is at the more worrying end of this spectrum, it is still a global trend within developed markets where we're seeing the rising yields. Sorry, I'm trying to string a rational sentence together at some point during this presentation. I've clearly not had enough coffee yet, or maybe too much. And there we go. So that's it's, not only is the 10-year yield increasing, we're also seeing the yield curve itself continue to steepen. That's as the short end gets pulled down by base rates tending to come down within global markets, central banks rather, and as we saw in the previous slide, the long end of the curve being pushed upwards, mainly as a result of bond markets responding to fiscal stress, for want of a better term. How well can developed market governments finance their expenditures? So in general, I mean, it's quite a funny thing. If the yield curves go negative, everybody gets worried because they're supposed to be a harbinger of recession. When they go positive, we're all worried because it's an indication of government's fiscal stress. There's no keeping bond markets happy, yeah? And the last one was I started off with positive indicators within markets. I just thought I'd show you this to cheer you up. This is the global GDP versus, for those of you that can't read, MSCI ACWI, you know, the probably the most heavily used global equity index, and you can see here, just to point this out here, the difference between GDP and global equity values is the largest it's been in the 30 years that I've run this chart for. You can see it opens up considerably around the dot-com boom, and then when the bust hits, it shuts considerably. It then falls back down in line with its being ACWI, in line with global GDP by about 2003. You see a similar thing, different drivers, probably what we're looking at now in terms of AI valuations versus internet valuations back in 2000 is a more similar story, at least on the face of it. But then you can see how far valuations fall back in the global financial crisis, well below that of GDP as an indicator, taking up to about 2015 to recover. It spikes again in 21, and then hits the buffers in 22, and we've seen this mainly driven by US large cap valuations, excitement around AI. You've got that massive, those jaws opening up there. That's not to say it can't go a lot further. You know, you can play pin the tail on the donkey with these things, and it's very hard to call where, when, and why a market corrects. But one would think that this cannot go on forever, and as one market pundit put it, if something can't happen forever, at some point it must stop. And with that cheery thought, let's see how UK fund investors are. So this Q3 flows overview of the UK fund market in general. Despite rising valuations, the UK investors are pulling back from risk assets. As you can see, money market funds are the most popular ones. Market funds money market funds, the ones taking the money, slight recovery with mixed assets, and equity US has taken something of a hit, certainly as compared to the first half of the year, and we'll see that's quite specific as we carry on throughout the presentation. What does this look like on month-by-month flows? The red section of this, for those of you who have to squint at screens, that's equity. The blue turquoisey sort of color is money market funds. I shall be very glad when another month passes, because then I will lose the far left bar of this chart, which was caused by institutional investors, in particular pension funds, rushing into money market funds out of risk assets in September, October 22. And then you won't have to squint, hopefully, quite so much at the other bars within the chart, and it becomes a lot easier to read. Obviously, that's a reaction to the mini budget. The other startling thing, or the most obvious thing about this chart, is what happens in on almost the far right of the bar, and that's that big red negative bar, and that is a big outflow of equities, largest ever. Actually, I could run this back to the global financial crisis. It doesn't get any bigger. Certainly doesn't feel like a global financial crisis, and indeed we're nowhere like it, but the reaction was very strong, and that is largely a result of outflows from US equity funds. They're very concentrated, and that indicates it's large institutional investors making concentrated calls. You can see that's whereas equities have been in redemption mode in the 2 subsequent months, it's not been anywhere near as large as that. On into the details. So UK flows, active versus passive for the third quarter. What does that look like overall? Well, it's no surprise to see that the big effect here has been in negative terms, money coming off equities. Passive funds have felt the brunt of that, and that is largely the bulk of that bar there, down to over 40 billion in the red, has come off US equity funds over July. On the positive side, as I said, investors putting money into money market funds, mainly GBP, also some money going to US dollar money market funds, which is a little unusual. Alternatives generally aren't up there, but as you can see, the amounts are relatively modest, all things considered. Bonds, interestingly, it's passives that are taking the money here. We've seen a little bit of volatility amongst bond fund buyers over the longer term, and it's expressed in aggregate here. It's passive funds that have taken the bulk of the cash, but at certain points, I think we've seen investors start to get a little bit worried if they're taking a little too much unrecognized risk in putting money into passives, and we've seen months where that's pulled back. The idea being that, as any active fund manager will tell you, that if you're putting money into passives, you're putting money into the most indebted companies in the market, and therefore you're increasing your risk. That's not always necessarily the case. You can actually invest in indices where you've got a control on the amount of debt relative to overall assets that you're putting money into, and I know FTSE Russell runs indices such as that, but by and large, where the money's going, that idea is correct. These are broad indices. If you look at where the money's going, that aren't constrained in this way. Further down, commodities, not much happening. Real estate, relatively negative. It always is, and interestingly still, mixed assets. over the quarter, seeing outflows. But as I said, the big story there is what happened in the equity market. It's been the case right the way through the year, but July was the big negative month. So the next one. So, quick look at performance here. As you can see, it's been quite volatile in terms of quarter on quarter who's been delivering. If you look at Q3, which is the far right hand of the bar, far right hand of the chart, excuse me. The green bar is FTSE China, which last outperformed strongly in actually the third quarter of last year as well. But overall, it has been performing quite reasonably. Next quarter previous, but remember, it's supposed to be uninvestable. What's also quite, I think, probably more important on this, unless anybody is thinking of making a huge allocation to China, is the recovery in performance terms of the far right-hand bar in all of these clusters, and that's the Russell 2000. That's small and mid-cap US companies, which has seen very, very heavy outflows. Small cap performance in general has struggled, but over the last quarter, we see a very strong bounce back for US small caps. Just in terms of value versus growth, so this is a style analysis here, looking at UK versus US value versus growth. Again, last quarter we've seen stronger performance, a bounce back by US small caps. Both value and growth have done rather well, value in particular. Over time, if you look at previous periods, and we'll see how this comes out in the wash altogether, this is a market that has struggled rather more. The last quarter is something of a change. What does that look like when you add it all up over time? Well, China has done extremely well over the year to date. This is the year to date graph, followed by Europe, followed by the UK. So for all the money overall that and the excitement that's gone into US markets, and wherever UK investors are doing, money globally, and particularly domestic money in the US, has gone into US equities. That's why the valuations continue to climb. They've still been beaten by European, UK, and above all Chinese markets. If you look down the bottom end of that graph, is still where the US small and mid and large caps have been. So, as I said, for all the talk about the Mag 7 and keeping dancing so long as the music's playing, performance is a little bit different. As you see, this. I've also looked at value versus growth, concentrating on US versus UK here, and as you can see, the best performing index over this period has surprisingly been UK large cap value. Is that reflected in the flows? It's an old cliche that says if you write a headline that ends with a question mark, the answer is always no. So let's see if that's the case. Well, Q2, that should be Q3. Oh, sorry, no, I tell a lie. What I've lost my own flow here, excuse me. So this is Q2 flows, okay? This is before we saw the large redemptions last year. You can see the leading classifications in terms of asset gathering, US equities, equity global. Mixed asset aggressive is always there, but yeah, focus that. Equity US, mainly passives, equity global, mainly active. And that was what was what the presentation looked like in the last quarter. What does that look like this time? Money market GBP, mixed asset GBP, aggressive up there, balanced up there. We're seeing some allocations to equity Europe. The UK has been rather slow to get on that bandwagon. Continental European investors were rather quicker to that party, enjoying the returns from that. But as you can see, a very, very, very different look at a view of allocations and flows over the third quarter. We look at Q2 redemptions. Bond Global, a lot of money coming there. Target maturity, which is a cash surrogate. Mixed asset flexible. That again is a small number of very large allocations, so that's big institutional investors making a call. And I think that's rotation from, despite the fact that we're looking at this as flexible, these are churns from really quite similar funds into aggressive or balanced funds. But moving on quickly into what that looks like now, it's kind of like, you know, the first shall be last, etc. Equity US, all the money coming out of passives as it was going into passives. Equity global, again, a lot of money has come off there. And these are, whether they're passive or active funds, these are funds by very large providers with very big allocations coming off the table. So again, this isn't Mrs. Miggins moving her pension into something else. These are big pension funds making these calls by the looks of it, or other large institutionals. Equity UK is the one, given that despite the performance of the UK market, we're still seeing money come out of UK equities. The reason for that is, I think the issue with the pension funds is really well known. The pension funds have moved out of equities, and their allocations were predominantly to UK equities into fixed income. We're also seeing wealth managers, as I've said before, shift their benchmarks from one with strong UK biases to more of a global benchmark. So that takes, I mean, if you've got a pure UK equity benchmark, that's by definition 100%. UK within global indices are 3 to 4%. Okay, so you can see what effect that strategic reallocation would have. And I think that's a process that's still working itself through.
Dowie, just have a couple of questions for you that have come in
on
the chat.
Let's see if I can answer them.
Yeah. So talking about the performance of the US year to date when hedged. So yeah, what is the performance of the US being year to date when hedged? Assuming it's not as bad as it seems if the currency is being managed. Any thoughts?
This is hedged. If I go back to this graph, this is hedged because this is all in GBP terms.
Okay, great.
So I think the S&P year to date is, I'm doing this off the top of my head, so don't beat me to death if I'm wrong on it. It's about 18 or 19%. Yeah, so it's not far off 20%. In GBP or Euro terms, it's in the mid single digits. So you're looking at like 5, 6, 7%. So there's a really significant currency effect there. Yeah.
Mm-hmm. And just kind of going on from that, there's also a second question. Any thoughts on the material US outflows being somewhat of a contrarian signal? Seems like the outflows have come just as the US seems like it might be about to take the lead again. Well, from a Mag 7 perspective.
Yeah, let's get back to that. I think that's a really good question. I wish I had a really good answer, because that would mean I was inside the minds of asset allocation committees of large pension funds. I'm not sure. I would suspect if you're pulling money off at this level, it's both the risk in terms of multiple growth is for sure growing with these US mega caps, yeah. And at some point, you would think that that has to correct. That said, at some point can go on for a very long time. As Keynes said, the market can stay, however mad you might think this is, I'm paraphrasing it, the market can stay irrational longer than you can stay solvent. I would expect there's also a currency view going on here, because the US government clearly wants a weaker dollar. So irrespective of what happens with the Mag 7, if they do continue to power on, in local currency terms, that will erode your returns. And that's what gives us the picture of this graph here, yeah? And indeed, this chart here, where the UK is considerably ahead of the US, dollar devaluation has had an effect here. So both of those you would think would be material factors within the decision in the decisions of asset allocators, and could well have impacted that really massive drawdown in July. Does that make sense?
Yes.
Okay, let's hope so. I think the interesting thing in this chart here, and given the what I pointed out in general over the quarter and year to date, and actually year to date, money coming off equity markets, particularly in July. I don't think there's a specific trigger for that July. It's not like the April tariff tantrum, but is who's not here. And also linked with that, how relatively small the grey bars, the equity bits are. So you can see legal in general out in front. It's done very well off money market funds, so indeed is HSBC. Vanguard, good split between, obviously this is predominantly passive money, bond, equity, some mixed assets. HSBC again, mixed asset. I think HSBC's got the biggest allocation. But yeah, makes for a more colourful chart, but there's a lot more yellow in here than you would normally anticipate. And that is the UK market in overview in general. I'll come on to sustainability in a minute. Any thoughts on this or any questions on this section before I stagger on? No, cool.
No,
okay.
No questions so far. If anybody does want to drop anything in the chat or come off mute at the end of the session, feel free to do so.
Right. I'll try and whip through sustainability. Outflows, yes, but in the same direction as the general market. You see the Q3 equities, a lot of that came off sustainable funds, although equity US over the quarter has done pretty well. UK SDR is the funds there are still struggling somewhat. It's not taken off in the same way that, for instance, SFDR has in Europe. That said, the criteria are much tighter than, for instance, an Article 8 fund. So the hurdle rate is high. You would expect that. Anyway, off we go. Sustainable flows quarter on quarter. Vaguely similar to the month-on-month one I started the general overview with, but again you can see there's a big change in Q3 of this year. The past two quarters, or the previous two quarters, this year, are the first ones that we've seen net outflows in general, but Q3 has been a biggie, driven by equities, and that's very much intertwined with what we saw in the overview of the market in general. This is clearly isn't a separate one. And again, this looks fairly similar here as well. Certain percentage of that large chunk of money that came off equities is in the sustainable market, although about a fifth of it. And given the magnitude of that, you've really got to squint to see the green bits on the rest of the graph. If we'd have rewound this, say, 2 years more, you'd have seen equities on the left-hand side of the graph and much of the dominating inflows, and it would have been a story of inflows, and much of that bar would have been green. So there's been a real change over the last, I was going to say 2 years, but really not much more than 1 year in this market. Positive flows, despite the massive outflows from equity US in general, actually sustainable funds have done reasonably well here, which is something of a surprise. Equity emerging markets done fairly well, and sprinkling across bond, equity Europe, Japan, and ex-Japan, despite Japan and APAC being markets that are still relatively unloved, despite reasonable performance by Japan. On the negative side, all that money came off. I mean, it's like comparing one with the other. So, like, it's very much equity global is the mirror image of equity US. So you've seen a big rotation out of global markets there. These are all quite similar funds in terms of they tend to be active or they're passive. The active funds run quite a low tracking error to the benchmark, and they are by major providers. And apologies, I keep repeating myself here, but the redemptions are coming in very large chunks, which indicates that these are big institutional calls. GBP corporates, some redemptions out of there, and the rest of it is again squint and you'll miss it. I think quite interesting still is that your equity theme, alternative energy, is still the asset class that continues to suffer. If we rewind, I want to say tail end of 2021 into 22, this was the asset class, if you remember it, with the popularity of certain clean energy funds, particularly ETFs that went up like a rocket and down like a stick, that suffered something of a liquidity crisis and has not recovered since, and has been very much hit because of the bond-like characteristics of a lot of alternative energy stocks really struggled as inflation spiked. So it's a very different world from 3 to 4 years ago here. Passive versus active in this market space. Interestingly, if we look at the left-hand side of the graph, what I talked about earlier with passive bonds in the market as a whole still having done quite well relative to their active equivalents over Q3, the reverse is the case within the sustainable market, whereas we've seen passive outflows and active inflows in the fixed income market. Over on the right-hand side, obviously we're not obviously, it's kind of like a 50-50 split with outflows over the third quarter. Who's done well in the sustainable fund market? Well, Legal & General once again. Surprisingly, there's more of an equity presence here. So sustainable equity providers have done rather better than their conventional peers, albeit that they're often the same people. But to work with. So HSBC, Legal & General, very strong equity flows, dimensional, almost all. Northern Trust, UBS, Mercer, completely. Aviva not looking quite so good on that one. And Schroders, the only significant player with mixed assets here, stretching it a bit, Legal in General and Aviva. But again, you can see there's much more of an equity presence over here. Moving quickly on then to a quick review of the SDR market, drop the F. Unsurprisingly, sustainability focused funds have the largest share of the market. Impact is the second most popular one. Mixed assets, despite the fact that there was quite a lot of pressure from the industry to introduce this, or mixed goals, excuse me, is much less the case. In terms of flows, having just panned mixed goals in terms of assets under management, it's clearly the only one that is taking net flows at the moment, mixed goals in the mixed asset sector, whereas sustainability focus continuously has seen outflows year to date. So it's a market that was introduced to make these assets clearer, more easy to understand, and therefore hopefully more investable. As you can see at the moment, it's yet to establish itself, but it's been a difficult market overall for sustainable assets. Any questions?
I don't see any questions on the chat at the moment, but if anybody is brave enough to take themselves off mute, you can pose a question to Dowie or just submit them to me.
There were good questions earlier. They were useful. Thank you.
Yeah. So obviously the big story is the massive outflows in terms of equity and people going towards money markets. Do you see that as something that's going to continue for the remainder of the year, or how would you see that trend panning out?
I think if anybody's really stuck for something to do tomorrow morning, register for the European overview. Skip the first 10 minutes because the macro is all the same. But the difference is that just to front run my own presentation, is actually we're not seeing this in Europe as a whole, as equities are still taking money. So the UK market is behaving differently, and I wish I had a good explanation as to why. Europe as a whole is not so risk averse. So, and of course, on a global scale, it couldn't be. You can't see valuations, equity markets climb as everybody's pulling their money out. That can't happen. So the UK is behaving in a more risk-averse fashion and has been throughout the course of this year, even if you disregard that quite heavily in the red July. But UK is something of an outlier. So I haven't answered your question. I've just gone, the UK is doing funny things, and I don't really understand why it's doing funny things.
Yeah, it looks to be unusual. Just to expand on what Zoe was saying there, we do have another webinar that will be taking place tomorrow at the same time, 10 a.m. And that will be the wider view of the European market, as Zoe mentioned. So if you have some time free and you're interested in that, you can still enroll in that as well. So as Zoe said, it will follow the similar kind of structure, but there seems to be this time there's a lot of difference between the European market and UK market behavior as well.
Yeah, and it's we've seen this at various times. So for back at the back end of 2022, after the mini budget, the UK market strongly detached itself and went massively into cash, obviously, and then started to drip feed that cash back into the market. Now you can understand why the UK would do that in the context of the institutional investors' reaction to the mini budget. Yeah, whereas continental Europe carried on regardless. Well, I mean, why wouldn't it? Whereas this year, I have to say, I'm a little bit flummoxed as to, there's a good word, as to why the UK should be behaving in a much more risk-averse fashion than our continental equivalents. It's an oddity. Maybe then somebody either side of this trade knows something important, possibly.
We've got one more question for you. So, do you buy the argument that money market fund capital is potentially cash on the sidelines to go back into equities and fuel more upside if it occurs? Or is it more about big institutional funds being able to park cash, get 4% on their money rather than 0% in cash?
Both of these apply. That's a really good question. But both of these apply. I know everybody. We all sit through these presentations, and the presenter goes, "However idiotic the question." That's a really good question. We're clearly told to do this, but that is a very good question. Both can apply. I think the second part of that is less the case at the moment with base rates going out. Base rates going down and the curve steepening. There is more of an argument to come out of cash. So I would have said that very much applied as rates were high and spiking upwards and curves were flat or negative. I think that's less so the case now. And that might apply, that might explain why we're seeing short dated bond funds doing well on flows. That actually, that cash that was parked in money market funds on the basis of return is starting to move a tiny bit up the risk curve into short dated bonds to get that extra return. So both can be true. I think the second part is less true at the moment. The other thing to be aware of that money market funds are used for is that corporates use them to park cash temporarily before a corporate action. So, for instance, a dividend, it could be a dividend payment, it could be a buyout or something like that. So that can also explain lots of flow, a lot of what's happening within money markets. From where we sit, it's hard to tell exactly what explains it, because although we know where the cash is going, we do not know who's deploying it. And that is often the case, not just for us, but for the asset manager themselves.
Okay, interesting.
So good question, but I'm not that simple an answer.
Yeah.
But yes, it could well be cash on the sidelines at the moment. I think that's better than the other explanation as things stand.
Yeah. Mm-hmm. Okay, great. Thanks for that question. It's definitely an interesting questions today. I don't see any further questions on the chat. I will give it one last time if anybody wants to come off mute and pose a question. And then I'll take that as a no. I think that's all the questions that we have for today. So thanks for that, Darry. That's the presentation. As we mentioned a couple of times, there is a look at the European markets tomorrow. Most of the data that you've seen today is taken from Lipper for Investment Management. If you have any questions on how the data was compiled in the presentation today, do let us know and we'll get back to you as soon as we can. Thank you all for attending and thank you for the questions, and I wish you all a pleasant day.
Thank you, and thanks, Claire.
Thank you.